Well, this is certainly something that nobody wanted to see. Canada's two largest railways, Canadian National and Canadian Pacific Kansas City, they have locked out over 9,000 union workers. That was as of 12:01 a.m. this morning, after months of failed negotiations with the Teamsters Union. This has now grounded nearly a third of the freight traffic that we see crossing the U.S.-Canada border. That's come to a halt. It's obviously raising concerns about some major disruptions in key industries, and think here agriculture, auto manufacturing, and energy. Now, the railways are arguing here that they have no other choice but to take this drastic action, and they're saying it's to protect the supply chain, especially with the busy fall season just around the corner. The Teamsters Union, that represents the locked out unions, and they're claiming that the railways' demands are unreasonable and put worker safety at risk. Paul Boucher, he's the president of the Teamsters Canada Rail Conference, and he says, CN and CPKC have shown themselves willing to compromise rail safety and tear families apart to earn an extra buck. The railroads don't care about farmers, small businesses, supply chains, or their own employees. Their sole focus is boosting their bottom line, even if it means jeopardizing the entire economy. The railways, they are pushing back on these accusations, and they're saying that their proposals actually would improve safety beyond what's even currently required by Canadian regulations. The economic fallout, that is going to be huge. That's something I want to focus on here for a moment. And even if there's a brief disruption, that could lead to some longer lasting issues. And this is mostly because of the railway's huge networks. The U.S. markets are also going to be impacted by this. A statement by a policy advisor at the Federal Reserve Board of Chicago says it will take weeks to unwind the problems caused by a shutdown of even a few days. The Canadian government will no doubt be under pressure to step in. The options for the government, that includes enforcing binding arbitration or pushing through back to work legislation. That would be a pretty harsh step, but they do have that in their toolkit here. So far, the government has been hesitant to take any of these steps. It's still in the early hours, so we'll see what happens there. But as this develops, the impact of the rail shutdown could become more and more apparent, and not only for the industries, but also for everyday consumers like you and me. We may soon notice shortages of some of the essential goods that we rely on from day to day. The talks between the railways and the union, they are expected to resume, but it's unclear at this point how or when this will all be resolved. TD Bank this morning, they reported a rare quarterly loss of $181 million. And most of that comes from a decision that it had to make to set aside a massive $2.6 billion US to cover potential fines from U.S. regulators. And these fines are related to issues with TD's anti-money laundering practices in the U.S. This provision alone wiped out what would have been a $2.88 billion profit for the third quarter. Now, on the bright side here, TD's adjusted earnings, they did hold steady. They came in at $3.65 billion. That's only slightly below what the analysts were expecting. Their U.S. retail banking division, obviously that took the biggest hit here. It reported a loss of $2.28 billion, again, mostly due to the fines it is expecting. Meanwhile, back at home here, TD's Canadian retail banking division had a much better quarter. They saw profits rise 13% to $1.87 billion. Now, besides the fines that they're expecting, TD also set aside almost $1.1 billion for potential loan losses. They're expecting that more customers might be struggling to pay back loans because of the continuing scene that we have here with the higher interest rates and, of course, just the general economic challenges that so many Canadians are facing. The bank also took a $110 million hit for restructuring costs, and this is mostly due to employee severance and cutting down on real estate expenses. Now, despite the pressures that the bank is facing right now, TD did keep its quarterly dividend steady at $1.02 per share. So I guess that's some good news for those of us who hold shares and who look forward to that quarterly dividend. Looking ahead now, TD is gearing up for a settlement with several of the U.S. regulators by the end of the year. Again, total fines here possibly will exceed $3 billion. In an effort to shore up its finances, TD recently sold shares in the Charles Schwab Corp. That was worth over $2 billion after the quarter ended, and that helped strengthen its capital levels. If you're looking for a balanced investment solution that can help you grow your money and generate cash flow, consider the BMO Balanced ETF. And this is a fund that invests in a mix of global equity and fixed income ETFs from BMO. The BMO Balanced ETF, it adjusts the portfolio every quarter to match the strategic index allocation weights. That gives you exposure to a wide range of markets and sectors. So whether you're saving for retirement, whether you're saving for a big purchase, or just simply want to diversify your portfolio, the BMO Balanced ETF can help you achieve your financial goals. Learn more about the BMO Balanced ETF today. Visit bmoetfs.com to find out more. With only 2 days remaining, it's still a very close vote in the poll question from last week's Pulse newsletter. Considering the challenges faced by TD Bank, would you be more likely to invest in TD or a competitor like Royal Bank? This question is even more timely today with TD's reporting their quarterly results. Now, I will put a link here to Saturday's newsletter. You can weigh in with your thoughts. I'll publish the final results in this coming weekend's edition. If you're not already subscribed, go ahead, give it a try. My goal with the newsletter is just to provide a tight and informative recap to the most important stories of the week. I'm sure you will find value in that. Click on the QR code here to join the crowd. The most recent U.S. FOMC minutes were published yesterday, and they show that last month, the U.S. Federal Reserve's officials were pretty much on board with the idea of cutting interest rates at their upcoming September meeting. They did decide to keep the rates steady in July, as probably you know by this point. They did make it clear, though, that a rate cut could be coming soon. The financial markets are betting on a 25 basis point cut next month. That would bring the benchmark down from its current range of 5.25 to 5.5%. There's a lot of people that think we could even see bigger cuts, and a lot of projecting a full percentage point cut by the end of the year. According to the meeting minutes, most Fed policymakers felt that if the economy continues as expected, it would make sense to ease monetary policy in September. They pointed out that current rate levels might be too restrictive, especially with inflation starting to cool off now and unemployment on the rise. The Fed is getting more concerned about the job market, especially since unemployment rate recently jumped up to 4.3%. And this has added just sort of another level of urgency to the discussions around these rate cuts. Fed Chair Jerome Powell, he gave a pretty strong hint after the July meeting. He said that the rate cut would be on the table if economic data looks right. The Fed, of course, as they always do, they're trying to strike this balance between keeping inflation in check and at the same time supporting the job market. And those are often in conflict with one another. So we're seeing that the inflation worries seem to be easing, but we're seeing that at the same time that the jobless numbers are becoming a bigger concern. Now, the minutes did reveal that not everyone at the Fed is so eager to jump on this rate cut bandwagon yet. Governor Michelle Bowman, for example, she thinks that they should still consider the possibility that inflation may pick up again, and she wants to be cautious about making any big moves. Now, on a speech on Tuesday of this week, she said, "It is important to note that monetary policy is not on a preset course. In my view, we should consider a range of possible scenarios that could unfold when assessing how the FOMC's monetary policy decisions may evolve." So she's making it pretty clear here that she's not ready to make any decision yet until she sees more employment and inflation data, which will come out before September's meeting. We will certainly hear more about what the Fed's thinking. Powell, the other officials, they will be speaking at the Jackson Hole Conference, which kicks off today. On Tuesday this week, gold prices hit an all-time high. The spot price closed above $2,514 per ounce, and that is a huge jump. It was almost $620 lower this time last year. There are a few big reasons behind the surge in gold prices. First off, a weaker U.S. dollar and expectations that the Fed might cut interest rates next month. We just talked about that. Those factors will make gold more appealing. Plus, central banks, they have been buying up gold at levels way above their usual pace. That's showing that they may be worried about inflation and economic stability. Now, Joe Cavatoni, he's a senior market strategist at the World Gold Council. He says, this reflects heightened concern with inflation and economic stability. On top of that, you have the ongoing geopolitical tensions, conflicts in Ukraine and Gaza, for example, that have added to uncertainty, and that more and more it pushes people to invest in gold as a safe bet. Gold is often seen as sort of a way to diversify and balance off an investment portfolio, especially when trying to make hedges against risks like inflation. And the UBS, they predict that gold prices could climb to $2,600 by the end of the year and even reach $2,700 by mid-2025. And that's thanks to the lower U.S. interest rates and a weaker dollar. But it's important to remember that as gold hits these new highs, it doesn't come without its downsides. And this is something every time we see gold go up like this, we see people rushing in to buy it without doing much homework. A lot of critics will say that it's not always a reliable inflation hedge like people think it is, and also that there may be better ways to protect against financial losses. The Commodities Future Trading Commission, it has warned that precious metals can be very volatile. They caution when economic anxiety or instability is high, the people who typically profit from precious metals are the sellers. So I'm just saying that if you're one of those people who's thinking about buying in gold now that it's sort of back in the headlines at these all-time highs, make sure that you educate yourself on the safe trading practices. With this world we have out there of social media right now, you have to be on the lookout for a lot of scams. I'm starting to see those in the comments of our videos here. So just make sure if you're going to take the plunge there, you do it in a safe manner. Don't forget to vote in this week's Pulse newsletter. I will put a link here. As always, thanks so much for watching. We'll see you in the next video.